You may have seen stories in our local paper this past week about fraud that occurred at two different businesses. In both cases, the bookkeepers were prosecuted after it was discovered that they had embezzled up to $100,000 over the last few years. One of the bookkeepers was actually discovered to have committed fraud at a charity where she also worked. You may occasionally read about these stories in the paper or hear about them on the news, but maybe you think, like I used to, that it's not very common. Fortunately, it doesn't happen a lot. Well, yes, I did think the same thing until a few years ago I got a call from two different business owners over a period of only about 4 months when I worked as a consultant and bookkeeper. In both cases, the person who called me had found out that their bookkeeper was apparently embezzling from their company, and they wanted to know if I could step in and try to help them figure out what had happened. Both companies, unfortunately, eventually went out of business, and both expressed the same thing, shock that it could happen to them. According to the Orange County Business Journal in 2014, 30% of small businesses meaning less than 100 employees, are victims of fraud, and that number increases to 40% for privately held companies. Think about that number for a moment. That is nearly half of all privately held companies that are victims of fraud. According to Appel in 2013, the average business or charity loses 5% of their revenue in any given year. The average cost of business fraud for small companies is $200,000. That is 14% higher than for a larger size company, according to Winter's study of 2010. These numbers are shocking, but research suggests that small business fraud can be prevented by 1, management oversight and awareness, and 2, separating operational responsibilities. Small businesses are disproportionately affected by fraud from employees, which is often due to just weak or absent internal controls. Management oversight and awareness can stop fraud from occurring, and for many small businesses, that is actually the only way that they can prevent fraud from occurring. Additionally, embezzlement and asset misappropriation, by which we just mean assets being converted to personal use, is accounting for 80% of fraud cases in small business, according to Appel's report of 2013. Weak or non-existent internal controls are a major factor in the occurrence of embezzlement. We'll talk about a few ways that you can help prevent fraud in your business today. According to Appel in 2013, the average business or charity group loses 5% of their revenue in any given year due to fraud. 13% of the time, this fraud is only uncovered by accident, according to the Orange County Business Journal's report in 2013. For many small businesses, management oversight is the only way to prevent fraud, but it doesn't actually have to be expensive or too complex for your small business. First of all, it may sound simple, but to start with, management should be alert and proactive by reviewing daily transactions. You might be surprised how many businesses and business owners have no idea how much money is in their bank account, and how many will actually tell me, I don't want to know, la la la, just take care of the numbers and make it all work out. That is precisely the attitude that leads to fraud, because there's no oversight. Managers should frequently review the books, look at their voids, aging reports, duplicate payments, any of those sort of reports for things that could be off. Be aware of bank balances, secondly. It's so easy now to review your bank balances online. Log into your bank account at least once a week. Just glance over the charges. Ask about anything that doesn't look right. One of the companies I consulted with after they suspected fraud had occurred found that their bookkeeper had been opening credit cards in the business's name and charging up a storm to remodel her house. The only way that the owner found out about this fraud case was when he stopped by the office one Saturday and happened to look at the mail and was shocked to see all these statements for accounts he didn't remember opening. This sort of thing could have been prevented had he been more active in the business and been aware of account balances and things that were going on a daily basis. Also, in the Journal of Accountancy in 2012, TISIAC recommends that you establish a code of conduct for your employees. Let them know what's expected of them and make sure they understand it is their duty to follow the rules and laws. Make sure also that you lead by example. If you're always looking for a way to get around the rules or to break the law or to cheat a little bit on your taxes, your employees may just follow suit. According to Johnson and Fluticil in 2001, 30% of small business failures are due to fraud by an employee or other non-owner, and 80% of fraud cases consist of embezzlement or asset misappropriation. Notice on this particular visual aid, a chart by Johnson and Fluticil of 2011, we can see here some of the types of schemes that have been conducted for asset misappropriation. You can see that billing, check tampering, corruption, and skimming are the top types of schemes that lead to fraud and embezzlement. This particular type of fraud is the most difficult to uncover and prosecute because small amounts are often taken frequently. Starting out with a small amount, the employee may take just a little bit. When that isn't noticed, maybe they take a little more, and it just escalates from there. Weak or absent internal controls are characteristic in companies with embezzlement cases. But one of the main ways to reduce embezzlement is simply to segregate duties among your employees. In the Orange County Business Journal in 2013, Appel reported that 52% of CPAs with over 12 years audit experience rate segregation of duties as the most effective method to prevent embezzlement. Of note is number 1, a different person should place orders, authorize payments, and make payments. And secondly, the person who is responsible for taking in the cash should not be the same person who makes deposits or records in the books. According to Winters in their article, Fraud Prevention Tips for Small Business, duties should be rotated among employees. In other words, change up who reconciles the bank account, who posts payments, who places orders. This not only provides a protection against fraud, but also will help cross-train your employees. For example, anyone can pick up the mail, then in turn they can give it to a manager who just glances over it quickly before giving it to a bookkeeper. Make sure your employees are taking vacations. Never put too much trust into one person. You never know. I tell managers never sign a check without an invoice or statement attached. Always look for backup. The simple act of actually checking these sorts of documentations and asking questions about them may help prevent any sort of fraud or embezzlement from ever occurring in the first place, just because you are aware. So in conclusion, small business fraud is very common, but it can be prevented through management, oversight, and segregation of duties. Remember, first of all, management should be alert to changes in bank activity. They should be aware of procedures and bank balances and be proactive by actually reviewing transactions, and let's not forget leading by example. Secondly, separating duties among different employees and rotating them, combined with some basic internal controls, will help prevent opportunities for fraud. Fraud in a small business can be devastating, and it happens far too often, but preventing it doesn't have to be expensive or difficult. Thank you for listening.